Now think, what is an inversion fair value gap? ICT, how do you know when you're doing your live trades and you're annotating them, you're calling an inversion fair value gap before it even forms, before it even trades there? Right. That's authorship. You would expect that, right? So let's go into it here. From this candlestick's low to that candlestick's high. Are you having fun? Are you learning anything today? Because I tell you, man, if I was my 20-year-old self and some guy was on the internet showing me this stuff over live price action, I don't know, I would be giddy. So now think, okay? If I'm bullish, if I'm expecting price to go up to here, and we're only right here, and we're trading up into it, everyone else that thinks that they see this as a liquidity void, or stocks being hunted and a liquidity void, and we're going lower, they would see that as a short entry. Not me. Not me. And I can say that because you watch me do it example after example of live executions. When I called it on Twitter a lot, I'd say, okay, take that fair value gap, extend it to the right. What am I telling you? I'm telling you that this right here, this sell side imbalance, buy side inefficiency, where the candlestick's low, that candle right there, which is that. Let me move it over just a little bit so you can see again. Let me zoom in actually because I want to make sure you understand exactly what's going on here. I want your money's worth, okay? So this candlestick's low and this candlestick's high right here. That portion on this candle, that's what I'm highlighting. What is that? The algorithm will go right back to this time frame, right back to this range in price action, being this. That candlestick's low and this candlestick's high. And we're gonna darken up that rectangle's mid level. Okay, and I want that to be bolder like that. Okay, so that's what I'm highlighting there. Okay, and let's go back out to. Oops, a little too far. Already, some of you already see what's going on, don't you? I can't believe it. I can't believe this stuff really works. So because I'm bullish, I'm going to look at old sell side imbalance, buy side inefficiencies, or down close fair value gaps as a rock climber. Okay, I'm going up. I'm trying to climb the surface of this rock surface to get to this liquidity. And maybe if I'm strong enough and hold on long enough, I might be able to get to the zenith of that high back there, like I talked about real time before I did it. If that's the case, I know that this imbalance exists. Because if this is there on the sell side delivery, part of a what? Part of what? A market that is potentially going higher, then I'm going to treat this as a foothold or a hand grabbing point as a rock climber. And I'm going to wait for it to trade up above it. My hand's going to use it to pull me up higher in my trade. And then I'm going to wait for it to, I'm going to get above it, and then I'm going to trade long when it moves into this area. Why? Why should I do that? Because it's going to act as support. Because why? If it's going to go higher, it's inefficient over here because it went down on this candlestick. Inefficient delivery and repricing for that range between this candle's low and this candle's high would be seen with candlesticks that go down in that same specific range that's highlighted in orange. Once we got above it, what did it do? It traded down to the low of it. And then what happened? Oh, look at that. Some mysterious movement to the higher side. And it ran into the buy side. Did it stop there? No, it ran right to the level I told you it would reach for. Okay? Is that hindsight, folks? Is that hindsight? Because this is the logic that I use every single time I'm making executions. Sometimes they don't pan out. I get stopped out. My entire move isn't given to me. Sometimes I enter with a pyramided entry, and I build in, and I absorb a little bit more drawdown in the trade that at the time I didn't want to see that much, but still I have to manage it. Just like you're going to have to manage. Every trade you get into, you have to be a manager of that risk. And every trade opens as a losing trade. You have to overcome the initial separation between where you bought and the spread, and you got to overcome the costs of that commission that you're going to pay, getting in and getting out, your real-time costs. So every one of us are losing traders, and you have to trade your way out of that. So the market does in fact do what? It trades down into the lower end in there. Now, before I start the live stream, and I got to get to this part because then we'll be at 9:30 where we can watch the opening range. I think I've already explained enough in here to justify why that's an inversion fair value gap. Inversion fair value gaps are old inefficiencies that are opposed to the trade direction you're in. When you understand this, you will understand how also my market maker models are not Wyckoff, because this right here is your unicorn. Second stage reaccumulation, smooth consolidation, smart money reversal, low risk buy, accumulation, reaccumulation, second stage. Whoop, whoop, whoop. Where's the biggest move? Right there. Hello. So, oh, I love this. Anyway, we're going to go down into the 1 minute chart. Okay, so now we have all the details over here on the 15. We can see the same thing being shown on the 5 minute chart. Look at the bodies. What are they respecting? Midpoint of that inversion fair value gap. That's a signature. That's a signature. Once we start running, I know that a stop loss, if it was down here, could be traded right below that. And I don't care. I won't worry about it. It could trade down to the lower quadrant. It could trade right down to the lowest of the low. And I'm underneath that low. And that's why you see me sitting in my trades. And you're just waiting. You're waiting for it to tick there. Get my stop. If it was Forex, it would never stay like that because the spread would open up because the brokers do that. Forex is still allowing their brokers to use their own liquidity to the reach and grab it. You're not in everybody else's pool of liquidity. When you're trading futures, everybody has the same high and low. That's an even playing field. That's why it's a gentleman's market. That's why it's a superior market. It is better than Forex. It is absolutely better than crypto. Futures, if you're going to trade, this is where you trade. I've proven it time and time again that if you know what you're doing, just because there is a spread there, they're not going to open the spread up for your one contract, for your micro contract. They're going to get your stop. If you got stopped out in futures, you placed your stop in the wrong place, period. That's the truth, folks. That is the truth, okay? But there is a way of trading, and that I've proven now, that you can have very, very pristine stop placement and management and still be able to be in the trade. But when I get stopped out, you see it. And usually it's good that I got stopped out, which is why I pay that stop loss to do its job. It's paid good money to protect me from losing larger amounts of money. But you look at this as I get stopped out. They beat me. They hurt me. They took something from me. No, you were protected. You were protected. It's insurance. It's insurance, okay? You're paying a tax, a toll to be part of this industry, this game, okay? You're not going to walk through it without having any losses. You're not going to. You're going to do it wrong. So let me get in here and map out what I showed, or what I intend to show you on the 1 minute chart. All right, so here is the 1 minute chart. And right in here, I started off this conversation with right below these lows, there'd be what? Sell side liquidity. And the market trades down, takes that liquidity out. At a time when we're in an inversion fair value gap, at a time where it would afford me a run up into 10 handles. Okay, so if I can get 10 handles there, I don't need to have the lowest low and I don't need to have the highest high. So if I know it can likely draw up to this price point here, that's these relative equal highs. You see that right there? So what is that? 17,487 3/4. That's this level here. 17,487 3/4. That's that high right there. So if I know it can draw to that level, and I'm under these lows here, inside of a fair value gap that is now an inversion fair value gap, that's this over here in the 15-minute time frame. Let me take that off. It's driving me nuts. Then I know this is a potential footing to send us higher. But is it time to make that price run there like that? No. But can I scalp it and get 10 points? Yes. And I'll explain what I meant by saying that. Just give me a second. We have the market trading below the lows here. I see the market taking out sell side. I want to be a buyer of that. But I saw a price on a 1 minute chart saying, okay, I can't get the lowest low, but I'm going to try to get as much as I can because I do believe we're going to go higher, at least 10 handles. What is this separation right here between this candle's low and this candle's high? If I'm bullish, it's a fair value gap, right? What kind of fair value gap? Inversion fair value gap. Watch. Right here to there. You see that? So in here, we're seeing price drop down, the market runs up, and we have a down closed candle, and we have market trading down into that. So we have several factors here that are building on this potentially being a short-term turn and then price running higher for 10 handles. That's all you need. Well, there's a trade. And my first entry right there was inside that inversion fair value gap right there. See that? Then my second entry was right here as we touched the low of that inversion fair value gap. My risk was right below that low. Very, very, very small stop. And the take profit was before getting to 88 or 87, what was it, 87.75. It was before that, just to get to 10 handles. That's how you start tape reading. You don't do the execution. Tape reading is not pushing a button at all. You're just watching price as it ticks and books price and say, okay, this is where I'd hypothetically expect price to go higher. And then see if it does that. And you do this for months without even pushing a demo account entry. You cannot rush this stage. You cannot rush the stage of seeing price action behave and perform a specific way. Because you're expecting to learn something that is extremely technical. It's very challenging. You're competing against extremely smart people in a market that's rigged. And most of you argue me and fight me saying it's not rigged. It's buying and selling pressure. It's price patterns that's moving price. It's depth of market that's controlling this. And it's not. It is not. It is not doing that, okay? It's not. Now, this is not the time for the run for the day. That's the reason why I only wanted to use 10 handles. What time, Dave? What time will the market run algorithmically? For the note-taking folks, the ones that are really taking it serious, learning, macros in price action, okay? Unless we're talking about the last hour between 3 o'clock and 4 o'clock in the US markets, okay? The last hour, 3 p.m. Eastern Standard Time to 4 p.m. Eastern Standard Time. There are 4 specific macros in that 1 hour time frame. Every single macro apart from that one is only 10 minutes till the top of the hour to 10 minutes after the hour. There's a macro in every single hour.